Welcome and thanks for joining us on Real Investment News. I'm Scarlett Fakar. Today we want to target those of you who may be ready to retire. You may be asking the question, should you pull out of the stock market? Well, today we're here with certified financial planner Richard Rosso as well as RIA analyst John Coumaianos. And guys, I want to ask you, what do you think about that?
You know, John, it's interesting. We're like dual nerds when it comes to retirement income planning and asset allocation.
That's right, we're the office nerds.
So you know what? You let this volatility that's finally taken hold, right? But everybody's been sort of complacent. Hey, I'm getting close to retirement, and I'm going to let my stocks ride. But that may not obviously be the right thing to do. It's like one of the things that we preach on the financial planning side is we don't care if valuations are where they are today, or even as you get close into retirement, 2 to 3 years, be willing to give up some of the gains because you don't want to be disrupted as you head into the retirement phase, right?
That's right. I know a lot of these target date funds are actually increasing their stock exposure under the assumption that people are living longer and that you'll need the gains that come from the stock market typically to see you through retirement. And I know you've written about this before, Richard, but I noticed an interesting article that kind of spurred this conversation we're having by Allison Schrager at Quartz, who wrote with a provocative title, "If You're About to Retire, Should You Pull Out of Stocks?" And of course she doesn't give a definitive answer. It varies from client to client, from investor to investor, but it's an interesting question. With stock prices so high, will you get the returns that exceed bond returns? You may not.
You may not. You might be facing a headwind when it comes to distributions and where assets prices are. That's why Lance and I had to adjust our portfolio or asset class returns lower going forward. And frankly, in the first year of retirement, you may not really be focused on the market. You're going to be focusing on your budgeting and just dealing with the emotional impact of going from accumulation to distribution. The last thing you want to do is face a bear market, correction or bear market, which could derail your plans. So don't get greedy with this.
That's right.
And we preach that is to get more conservative. Hey, and there's nothing wrong with, as you go through retirement and valuations on stocks get better and PEs become more attractive, you can add stock exposure. Matter of fact, after 2 or 3 years where you're comfortable and in a groove for your budget, there's nothing wrong with that if valuations allow it. What I notice is a lot of advisors or brokers, they'll set a conservative allocation entering into retirement, but then they let it go and they let it stay conservative, and that may not be, I don't think it's the right thing to do if valuations allow more breathing room for stocks.
That's right. I think Richard raises 2 interesting points. The first one is a psychological factor. People embarking on retirement, leaving their jobs finally and starting retirement, have to get used to that way of life and have to get used to pulling income off of their assets, which they've never had to do before. I mean, don't forget, you've spent your whole life, typically up until this point, building your asset base. And so you have to go through this transition, and market gyrations can really disturb you and make you not want to take the money that you had planned to take, and
that's right,
and change your plans, which is very rarely a good thing.
We find even when we run financial plans and someone has the money, they're emotionally vulnerable.
Sure.
So the last thing you want to do is create a lot of volatility. We call that first year in retirement generally the black hole. You're just trying to feel your way through emotionally, trying to figure out who you are in this next cycle. And again, it's really not as much financial as it is emotional.
Right.
Because I can show your plan being incredibly successful, and guess what? You're still going to have a problem emotionally going from, hey, I've been putting money into this account, I've been an earnings machine, now on my earnings machine potential is maybe down to 0, but I have to now live off of this capital.
John, you sent us an article and it did touch on the topic of retirement planning. Can you explain that to us?
So this is actually an article I wrote a couple of years ago when I was at Market Watch, and I decided to test 2 portfolios. I used the 4% retirement rule, which is the first year you retire. The old rule might be changing, but the old rule was take 4% of your assets and then boost that by 4% every year. So I did it twice. I did it with a pure stock portfolio, then I did it with a balanced or half stock, half bond portfolio, and I made the retirement date January 1st, 2000. And it turned out that the person who retired and put their money in a balanced portfolio did much better, even though the stock portfolio produced a slightly higher average annual return from 2000 to 2017. The reason for that is what finance nerds like Rich and I call sequence of return risk. If you get some bad years in the beginning, which you did, 2000, 2001, 2002, when the tech bubble was blowing up, the portfolio draws down so much, and you're taking money out of it on top of those investment returns, those bad investment returns, so that the portfolio essentially never recovers. And if you're in a half stock, half bond portfolio, just the stability that the bonds provide allows the portfolio to maintain a higher level throughout the distribution phase.
Okay.
And what John's saying is the first 10 years in retirement and how you distribute and what kind of stock or bond returns will make or break the following 10 and the following 10. So having a blended portfolio as opposed to 100% in stocks will help you minimize some of that downside risk or those headwinds that you can face.
Now, I want to ask both of you, how much of your retirement savings should be in stocks, period?
Well, we always suggest 2 to 3 years or maybe 2 to 5 years before retirement, you start whittling it down. And that depends on whether it depends on your personal needs, but it also depends on where stock valuations are and where they are today. If you look at the Schiller PE at 31 times, you might be able to save 20 to 30 to 40% at most in stocks at this point as you right lane and enter the retirement. Again, I don't think you're going to give anything up by having 20, 30% in equities. And then over time, as you would get into the groove, and you see what your drawdowns or your distributions look like, that you can adjust higher, especially as valuations work themselves off.
I would just echo Richard's point. There's no great need to really boost your stock exposure very high. Right now, the 10-year Treasury is yielding almost 3%. If you have a diversified portfolio of bonds, you can probably touch 4% as a longer term, as a 10-year annualized return just from bonds. It's not certain that the stock return will match that. So don't need a whole lot of stock exposure, certainly in the first few years.
Those who are retiring today may have much more of a headwind than those who retired when it comes to returns and retired in the bottom and low 9, especially if they protected their capital and then went back into the market.
Well, thank you so much both for joining us. That is it on Real Investment News. Be sure to like us on Facebook, follow us on Twitter. This is on realinvestmentnews.com, as well as our YouTube page. We'll see you back here soon.